Today's episode is brought to you by Mazars.
SoundCartel.
From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. This year continues to be a rollercoaster for investors. What happens overseas has a significant impact on our local currency, inflation and investment vehicles. To explain what's going on is investment expert Elio D'Amato, who's been with us since the beginning here at Business Essentials Daily, previously Business Essentials. Elio is also a regular with his share market report on the ABC, and he's a contributor to the Australian Financial Review and other media. And now he's part of the team at Stockopedia, Australia and New Zealand. So to start, Chris Ashmore asks Elio how the wider economy is guiding the action of investors.
This idea that inflation may have peaked has also done quite a bit to steady investor nerves in the face of what has become an obvious margin crunch. We'll talk a bit more about that a little later on. But many CEOs are for the first time learning to do business in a rising rate environment, and that throws up challenges that many have had to come to terms with. And I suspect the reporting season that we're currently in is going to give us a bit more as to how things go. Now, this is very different, though, to our friends in the US, who, for example, their markets have actually done quite well in this Goldilocks economy that they seem to be in, where they've got not too much inflation, not too much unemployment, and growth is just right. Whereas our market, well, we're a little more sceptical. We're not that far from all-time highs, though, so we shouldn't be too pessimistic, and things are really not that bad. Of course, we do have a current problem on our doorstep in China, and obvious signs there that their economy is spluttering potentially could have an impact on us in the short term. So the entire economy, government and everyone will be keeping an eye on that one.
Now, the Aussie dollar seems to be a bit low with the greenback. Is that having an effect on our investments?
Yeah, that's all wrapped up with this China story I alluded to. So there are some things going on there that investors do need to be aware of. For example, they're currently experiencing price deflation, which is not good because when you think about price deflation, why would customers buy today what they could buy tomorrow for a cheaper price? And likewise, why would a business invest today when they can invest tomorrow at a cheaper rate? So this has not caused a cataclysmic decline in our market yet because deflation is something that China's had to deal with a few times in recent history, obviously much of that COVID-induced. But now that that's behind them, observers are a little bit worried and will be hopeful that this doesn't become a consistent period because if it does, then that could really throw a spanner in the works for their plans of internal consumption, which is what they're really hanging their hat on to drive economic growth. Because as I alluded to, it is spluttering. There's also talk of wealth managers missing debt repayments. You've got property developers like Country Gardens who's suspending their bond repayments. There's real strains occurring in the Chinese economy at the moment, and hopes are that that internal stimulus will come sooner rather than later and hopefully big enough to really actually make a difference. Now, all this has impacted our commodity prices and the perceived demand for them, and therefore our currency. And it's been unsurprising to see the Aussie dollar weaken as commodity prices have had a few months of some weak trading themselves.
Now, earlier you mentioned the reporting season, and as we record this, we're in the middle of it. What can you tell us about it?
Well, companies are laying their financials bare, and the theme always was going to be margins this period. No better evidenced, I suppose, by ResMed, the breathing apparatus company, who were able to grow revenues, but tightening margins really took a dent to their share price. Now, everyone looks at sales growth. I know it's the top line. It's the most spectacular number, but it's really margins because they are the growth expander, or profit expander, I should say. And unfortunately, they can also be the great profit contractor if they go the other way. And obviously, as the cost of doing business increases in recent times, companies will want to be increasing sales by a rate higher than what their costs are going up. So You look at JB Hi-Fi, for example, you can do it because they reported a decline in revenues, but they kept their cost of doing business under control, and the market really liked that. So they can do it. It is a bit of a challenge, but if you can keep your margins in check, that will be the theme this reporting season. Those that don't will suffer. Those that do will thrive.
And for punters out there, how's the share market heading at the moment?
Yeah, zig and zagging like it always does, swinging between euphoria and despair. That's its course every day, modus operandi as it were. Now, our market really has seen a bit of that zigging and zagging. Essentially, we've been going sideways for the last 2 years, and to be frank, until the S&P 200 breaks above that 7,600 mark, which is the all-time high, we're pretty much going to be going sideways still. So, look, the good news is there's always opportunities in stocks if you look hard enough. The reality, though, is that over the last 12 months, cash-hungry businesses who shone the lights out, actually, back when interest rates were really low, because, of course, it was quite cheap to get debt and it helped with their valuations, unfortunately, they have really suffered. So the market is more discerning on quality at the minute, and for good reason, and is not as willing to take a punt just yet.
Any industries doing well and any industries that aren't doing well?
Well, notwithstanding what I just said, IT has actually been a very strong sector in recent times on account of their strong margins that they have and the recurring nature of their revenues. So profitable IT businesses have actually had a very good 18 months, to be honest. Energy's also done well after what was a horrible financial year last year. OPEC continues to cut production. Well, it's doing that, but it's really not, or hasn't done too much to price until recently. Coal, well, the coal prices have just stopped falling. They haven't necessarily risen, but at the very least, the short-term pain has been felt. Consumer discretionary has also been doing well, which again is another surprise, showing the resilience, I suppose, of the Australian consumer. A lot of the price declines that had occurred had been occurring in the very months prior. Materials, though, they have suffered on the back of these Chinese concerns. Unfortunately, that has really been a bit of a drag on the industry. And you also look at real estate for obvious reasons. As interest rates go up, property valuations have also been coming down, and the cost of actually building something has gone up as well. So when you get that dichotomy where you can't grow sales but your costs are going up, that really hurts the bottom line, and investors have been walking away from that sector in droves.
You know, Mazars have been a long-time supporter of SoundCartel, and now they're helping us bring you this podcast. To find out how Mazars can support your business, visit mazars.com.au. That's mazars.com.au.
Now, a lot of tech companies, Elio, they've shed a lot of jobs. That doesn't seem to matter with the tech industry, though?
The fact of the matter is they're getting better at what they do. In particular, they're getting better at running businesses. Now, when rates started to rise a few months back, we saw a number of IT companies become laser-eyed focused on becoming cash positive, either this year or next. Now, no longer could these stocks really be cash-burning machines. Staff are a major cost, of course, to an IT firm. So if they wanted to keep these juicy margins that they're famed for, then they just had to let staff go, unfortunately. And look, to be honest, they've been one of our best sectors, actually, this year, and it was our best last year. So them getting cost conscious and really keeping their eye on cash flow has really helped the overall sector.
Cryptocurrency, is that out of favour now since the collapse of FTX in the United States and the fall from grace of their CEO, Sam Bankman-Fried?
Yeah, almost forgotten about in a time of inflation has really been the crypto cult. Look, to be honest, it's still there. And in fact, it's actually had a reasonable 2023 to date. So less eyeballs that look at it often, you'll find that things tend to float on the way up. Now, they're still some way off from their peaks of 2021, of course, and they're still mired by poor corporate governance, as you alluded to, and, of course, sinister influences. But at $29,000 per coin at the moment, faith has been returning, and Look, actually, it's been doing a nice step-up motion, so I'm sure the true believers will find hope in that. But of course, it's becoming increasingly linked to what's occurring in the real world, and in a world of make-believe, that just doesn't make sense. But there you go. But it's definitely finding a bit of support in the last few months.
Well, finally, I suppose we can end with your stocks to watch.
Auto classified stock car sales came out with a very strong profit figure of $278 million, which was 43% up on the corresponding period last year. Revenues also grew quite strongly, up some 53%. They are expected to continue to deliver growth in profits and revenue in 2024. And what was really pleasing is that the Webmotors and Trader Interactive acquisitions appear to have been quite shrewd, with 50% of their revenues now coming from offshore. So just remember that the next time you look up a car. Janus Henderson, JHG, is our top-rated financial stock at the moment. They've got a quality score of 92, a value score of 87, which puts them up there, as well as a momentum rank of 95. So as active managers go, they've been on the nose in recent periods, but this one here tends to be our top pick because of the fact they've been able to keep money in the business, and they should grow should markets continue to recover. Now, this might seem nonsensical in the time of a rising cost crisis, but Satire, an online site that sells luxury goods, if you can believe that, they saw some extraordinary growth. They saw revenue jump some 98% to $416 million. Now, net profit was actually $16 million versus a loss of $19 million the year before. Quite outstanding, really. But then again, it makes sense when things get tough. You don't necessarily go to the store to go buy it. You'll just buy it off somewhere else where it's discounted. And that's where Satires really benefit because, of course, people need that Balenciaga bag. Realestate.com continues to be incredibly resilient in the face of worrying signs out of the property market. Despite revenues reducing and margins also being impacted, they actually came well ahead of expectations, delivering a $1.2 billion annual profit. So that was quite resilient and deserved the re-rate that it experienced. Building construction materials are also a sector we do like. So stocks like James Hardie, who came up with a quarterly update flagging good growth ahead, as did Boral, who is expected to make $300 million worth in profit next year, and therefore, by extension, you can't exclude CSR, another building material company that's quite quality. So, obviously, reporting season will throw up its new list of stocks, no doubt. These companies have reported that I've just discussed, in case you're wondering, folks. But I think we'll be pleasantly surprised by the strength of our businesses, but do keep an eye on those margins.
That was Elio D'Amato, investment expert at Stockopedia, Australia and New Zealand. Business Essentials Daily is a SoundCartel podcast. Producers are Nick Schildberger, Chris Ashmore, Jeff Waters and myself. Technical production by Pete Letts. I'm Nicole Goodman. Thanks for listening. We'll bring you more B Daily next week. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.